there's always somebody who gets the last look, and it's usually the guy that's been in business 20 years, and it's not even always the highest price. Sometimes it's the guaranteed closing. So that's what we try to focus on.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. I'm your host, Jack Krupe, and I've got Zach Garizo with me. Zach, thanks for coming on again.
Always, Jack. Thanks for having me.
All right, so today we want to talk about how distressed is it? And right before we got started, we were kind of talking about 2008 versus now, and I was at the bleeding edge of the 2008 crisis, and this is drastically different. I don't even know that I'd call this a crisis. 2008 was largely residential focused. You had a lot of people in bad mortgages that were going up in interest rate automatically, regardless of what the interest rates actually did. They were option arms that reset, and it practically took down the banking system if it wasn't bailed out. It was systemic and caused a lot of pain for a lot of people. However, now, at least on the residential side, 70% of homeowners either don't have a mortgage or are locked below 4%, and there's an unprecedented amount of equity as well. Some of that is due to inflation. Some of that is due to just COVID and people moving. Some of that is just still a supply shortage. The fact is there was never enough housing built after 2008 to make up for the increased demand. So, things are not going to be like they were in 2008. I've talked to a lot of people who are saying they're on the sidelines waiting for a crash or correction, and I don't see that at all on the residential side. Now, the commercial side is a different story. Now, it's not as widespread as that the residential side was in 2008. There's a lot of noise. There's articles in The Real Deal. There's high-profile foreclosures for sure, and there's certainly going to be a lot of pain, especially in the office sector. But the fact is there's still a very small minority of the loans, even in multifamily, that are bridge loans. I think I saw a stat. It might only be 10 to 15% of the properties are actually stuck in these bridge loans, where largely these were operators that were doing very similar to the strategies that we implement, buying, renovating, raising the rents, and then eventually selling. So for some of them, it made sense to use these bridge loans because they were only going to be in a property for 2 years. And if you go with long-term debt, there's very high prepayment penalties. So there's really a small percentage of the overall loans that are in this category, and there's a lot of money on the sidelines. Unlike 2008, where there just a lot of people got cleaned out, and there wasn't as much capital or dry powder to come in and take things over. Right now, I mean, there's tons of funds sitting on billions of dollars that have piled into real estate over recent years. So. For that reason, I don't think there's any sort of crash, but there are some very good opportunities for sure.
Yeah, no, I think you're right, Jack. And I think this, you were working in the middle of it all in 2008 and certainly saw the differences, the parallels between now and, of course, then. Can you talk a little bit about what the differences are for kind of the banking perspective of it? Because we're seeing a lot of these loans, starting to mature this year. There are a lot of payments coming due. Can you talk a little bit about the differences for what this means for the banks?
Yeah. So back in 2008, there had been prior crises. There was a savings and loan crisis. There was, there were things that happened in the 80s and 90s, but the size and scale, the banks were not prepared, and there was not really a system or even guidance from the banking regulators on how to handle that much of a widespread default. So now there's a much clearer roadmap, and banks are way more conditioned to work with borrowers They can do modifications. They can do modifications in a way where it does not penalize them so significantly to modify a loan. And, largely they feel, and it's structured so that, especially if the operator or the borrower, has a game plan, is potentially able to put some new money into the deal, they can provide some interest rate relief. So we're seeing a lot of modifications, and it's a win-win. Generally the banks don't want to take properties back. That's been true across the board. One of the problems in 2008 is a lot of the loans were either owned by government agencies that had pretty strict regulations on what they could and couldn't do. And our business at that time was buy loans from the banks, and we had a lot more flexibility. And we created win-wins. So that's what we're seeing right now, is that we're in a number of the deals we're in with fixed rate debt. I believe all but one has received a loan modification, and they're pretty generous. In some cases, lowering the interest rate by 2% for the next 2 years, which should give us and our partners time to finish renovations and sell.
Right. Well, and that's just something that is completely different from 2008, where there's just too much volume of bad debt, because you're working with individual homeowners rather than in this case a lot of large operators who are having to go through and get these loan modifications, or having to go through and work out a new strategy moving forward, maybe change their value add timeline. But it's not the same as an individual homeowner who really a lot of times didn't even know about what was going on until it was too late. And that's also one of the reasons, like you said, that we have so many renters in the United States right now, and commercial real estate occupancy levels are still very high. We haven't really seen much of a drop, even with new supply coming online. Is that right?
Yeah, that's absolutely right. And I listened to Peter Zeihan a lot, and he said the millennials kind of got screwed. They were kind of coming of age in that post financial crisis. There's a few years where the job market wasn't exactly great. They weren't maybe established enough to buy at the bottom, and now that generation is in their late 20s, 30s, etc. It's very expensive to buy a house right now, comparable to in the 70s, 80s, or even when I got started in real estate in 2001, post .com crisis. The real estate, it was before that last real estate boom, and then but right now it's just really really difficult. The affordability index for you really need to make six figures plus to afford a house in most markets, especially the growth markets where people are moving. The Southeast and the Sun Belt. Add to that, that's often where the baby boomers want to move to. So you've got baby boomers that have maybe a house that's either free and clear, or that they've got a ton of equity. They can move to Florida, pay cash for something. That's keeping the prices up, where the younger person who's saving up 5-10% down, they just can't afford to get into a house. It's way cheaper to rent. So we're seeing that, and people are renting longer, and people are also a lot more mobile than they used to be. It's not it's not the 60s where you buy a house, you get a job, you stay there for 30 years, you retire. People want to be more mobile, so having that optionality to just be on a year lease, and if you're living in Charlotte one year and then you got an opportunity to move to Texas, you move to Texas. If you want to move somewhere else, you move somewhere else. So people don't want to commit as much. I mean, it's the era of swipe right. You could swipe right on your new job, swipe right on your new house or apartment.
Or like us, swipe right on what could be a totally, basically different country.
Mm-hmm.
Puerto Rico is of course part of the United States, but might as well be its own. Colombia, another place. Yeah, it's very different from 2008 for a number of reasons. So I mean, we've talked a little bit about how it's different for the banks, a little bit how it's different for the renters, or who would be the single family home buyers. Now, let's talk a little bit about the operators. How is this a little bit different? How many of the operators do you think we're seeing who are having a bit of distress? How many of them do you think really made it through 2008, or were even operators at the time? And what does that level of experience do?
Yeah, it's certainly a mix in the broader spectrum of things. Most of the deals I've gotten involved with, and we've gotten involved with, are with operators that have been around. It's people I've known a long time, people who have the scars. There's really only one way to to have really learned from it is you have to have some scars. You have to have seen that things can change, things can go down. And even with that said, I mean, this is a pretty unprecedented move in the rise of interest rates, more than even some of the most experienced people I know expected them to, move so fast, so quickly. So, it's hard to prepare for everything. And I've quoted this more than once, but, Howard Marks has this great book on market cycles, and he says, history may not repeat itself, but it does rhyme. And so, this is not, no cycle is the same, but, ultimately the Fed raised interest rates, and those that were too aggressive, had too high of loan to value, had, banked on just buying an interest rate cap and just didn't plan for what happens if rates go up 5% in a year, have some challenges. Largely those that have been through various cycles, I think, stuck more to fixed rate debt. Not all, because again, sometimes it was kind of a necessary evil in some cases. If your plan is to buy and sell within 2 years, it was very difficult to go with fixed rate debt in any scenario, just because the prepayment penalty would take away a majority of the profit. It just wasn't you wouldn't be able to execute your business plan. But there's definitely, when I see the real deal and see some of the people in distress, there's definitely a lot of them were not through 2008. A lot of them were kind of new to real estate. A lot of them got in 08, 09 at the bottom, just kind of timed it right and had a great 10, 12-year run. And, now that, as Warren Buffett say, when the tide goes out, you see who's swimming naked. So there's definitely some high-profile people learning some lessons. With that said, there's still, just because some people are newer, I mean, there's a group that we're in a number of deals with that, has over $1 billion of debt, and very sophisticated group. The guys came out of, one of the large private equity funds. So they had institutional experience, very well connected with lenders and banks. So, just because they're not 60 years old, doesn't mean there's not good operators that are younger. So, as someone in his mid 40s, I definitely don't want to be, completely, I'm sounding like that guy now. That's when I was a kid. But the one thing I'm
Back
seeing
in my
is,
day.
Yeah, the big difference is it a sophisticated group that runs like a private equity fund, or is it a group of people that went to a class, club up together, raised money from their friends and bought a deal? Those are the people that are in the biggest trouble that I see. And we've seen some high profile. I think there's a couple deals in Houston where the guy just fled the country. The guy who was the main operator raised a bunch of money, ran a project into the ground, and is basically just left the country now, and investors got completely wiped out. Those are terrible scenarios, and I feel bad for those investors. Fortunately, the deals that we're in that have modifications, our sponsors are proactive. They're operating the property reasonably well, and the bank is confident that it's better for them to continue to execute their business plan for them to try to force a foreclosure. So they're being proactive with modifications, and it helps to have that scale. There's that saying: if you owe the bank $1 million, you're screwed. If you owe the bank $1 billion, they're screwed. So
right.
Some of these balance sheets, they want to modify. They want these loans to still be modified and performing, even if it's subperforming. They might get categorized slightly different by a banking regulator, but it's certainly better than having them categorized as a foreclosure. And some of the banks, if they really force the issue, they'd probably lose principal. There are loans that are potentially underwater right now just because at a 5.5% current interest rate, or with the 10-year at 4.2, and a project that's not finished with renovations, they probably won't sell at a profit. However, if you give the projects 2 more years and you're raising the rents still a few $100s each unit that's renovated, that's creating millions of dollars of new value. And even if rates are still at this level in 2 or 3 years, that increase in net operating income and increase in value, should still yield profits on a majority of the deals.
Right. Yeah, no, I think you're 100% right on that. And, we all go through and we read the news, we check the latest sites about, commercial real estate's in trouble. This operator is having issues. This market is doom and gloom. Can you talk, I guess, a little bit, Jack, about what we're seeing outside of the headlines, right? As someone who's done over 50 syndications, you mentioned having well-capitalized partners who are, very aware of the interest rate fluctuations, but have the experience and the capital necessary to keep going and continue with the same value add plan that we may have invested in years ago.
Yeah. I mean, very, very fortunate to have some really good partners. I mean, one of our partners that comes to mind put $3 million of his own money at 0% interest just to keep a deal moving. The bank was slow to release the construction draws, and he just wanted to keep moving. So he loaned in his own money to make things happen. With interest rates fluctuating, we have a few deals where we're trying to time a refinance. We had one that was supposed to be a short-term, maybe an 18-month flip. It was it's the smallest deal from a unit count because it was only 18 units. But the plan, it was bought as it was basically built as condos, but it was always run as a rental. So we bought it as a rental, and the plan is at some point to reconvert it to condos, because on a price per door basis, it was maybe 50, 60 cents on the dollar compared to where condos would rent. But because of that, we're in variable rate debt. And fortunately, very well capitalized partner. And when rates skyrocketed to 5 on the 10-year, it would have been a cash in refinance. But we didn't have to worry as partners in the deal, because they could have easily funded the shortfall. Now, luckily, with rates, the 10-year was back under 4. It's at 4.2. So now we're just trying to time the refinance. And with the rate at 4, it's no longer a cash in refinance. It might even be a small cash out refinance, but we probably don't take cash out. We probably just refinance, and then our debt payment drops dramatically, and we'll sell it in a few years. So, having well capitalized partners like that don't really even need our money, but everybody needs money. Even well capital, even family offices that are running hundreds of millions of dollars, they like to work with other people's money as well. And because when there are major opportunities, it's always good to have people to call to have extra capital, so that you can, when the right deals fall in your lap, or 2 or 3 happen at the same time, you have the flexibility to take advantage when those things happen.
Sure. Yeah. So a lot of people are saying there's a lot of distress. We are seeing it. It's not the end of the world for a lot of these strong operators who know really how to navigate the difficult waters. Can you talk a little bit about, who's buying now? If there is fear in the air, there's a change of times that many are seeing. Can you talk about why this is also then a good time to buy, right, for these proven operators who are already navigating a difficult time? What are they seeing in terms of new deals on the market?
Yeah, so the key is who is selling now. If you're a good operator and you had long-term debt, there's no reason to sell right now. So most of the deals that are selling right now have some level of distress or some level of life event. There was one deal one of the deals we invested in the fourth quarter. It was an estate. The patriarch of the family who had built up this large portfolio passed, and multiple heirs. They just want to sell. They want their money out. They're not real estate people. So that's just a life event thing. Otherwise, a majority of the deals selling right now are selling because they either are undercapitalized, they have bad debt terms, and they either need to sell or they need to put money into the deal to refinance, and they don't have enough leverage to get a modification from the bank. Not leverage like high loan to value, just leverage like the financial wherewithal and to build the confidence with the lenders to extend the loan terms for them. So those are the deals that are coming to market right now. And if a deal works at a 5.5% going in, or some rates are in the 6s, because if the 10-year is 4.2, you're going in rates probably 6%. So if a deal works at 6% now, some of these are 20% cheaper than they would have been at the peak of the market 2 years ago. So there are amazing opportunities, and look, this has washed out some of the newbies, some of the pretenders, some of the people that were overpaying. There was also a point where people were putting hard deposits day one without due diligence. There was a deal that someone shopped to us that they lost $500,000 hard deposit, and they actually beat out one of the operators I just mentioned that we're partnered with. He was looking at the same deal, and the guy, hard deposit day one, couldn't raise the money. Eventually came back to us and was a little late in the game, but potentially might have even gotten bailed out by my original guy. But he, probably as he paid, he'd offered too much too. And that was just some craziness in the peak of 2021. I mean, people were just getting wild. And I'm glad that we're not the day-to-day operator with that, because you're looking at hundreds of deals, and it's you could look at hundreds of deals and spend $1 million chasing deals and not get one, and especially in that market. But there's always somebody who gets the last look, and it's usually the guy that's been in business 20 years, and it's not even always the highest price. Sometimes it's the guaranteed closing. So that's what we try to focus on. Is I don't want to be recreating the wheel and chasing deals and competing with guys that have been doing it for 20 years. I don't want to try to beat them. I want to join them.
Yeah, no, and we're seeing this a lot with the proven close. I like that that little fact there. We're seeing it a lot where anyone who has these strong broker relationships and is able to have that proven close, that's proven more important than getting top dollar. I mean, we spoke to an operator not long ago who actually, I remember, was bidding on a project in 2021. They lost out, and now they're getting another chance to buy the same property because it's not that the property isn't performing. It's that there are large operators who are in distress and just have to shed assets, and they have to get some of this off the balance sheet. So it's like we mentioned at the start of the show, a lot of this distress here isn't even property specific. It is mismanaged. It's bad operating procedures, and the interest rates sure aren't helping. But in a lot of ways, some of these operators wouldn't have made it whether the interest rates changed or not. And now I think we have a longer time horizon for investment. We're seeing less 2-year flips and more 5 to 7 year stabilized holds, and that's creating a lot of strong buying opportunities for. I mean, like you said, we've seen 10, 20% discounts just in the last week for, good assets in very strong locations.
Yeah, it's great. And as someone who, I made pretty much all my money post 2008 buying distressed loans, modifying distressed loans. It's an exciting time to see, a little bit of blood in the water. I mean, this is nowhere near like 2008, but we're also dealing with a lot bigger dollar amounts. One of our private equity fund partners put $8 million into a deal recently, and it wasn't even what I'd call a distressed deal, but it was a loan assumption, assumed a 3% loan. So there's also those that do have fixed rate debt, the ones that most of them just don't even want to sell because you could ride out super low interest rate. But if you have that type of debt, it becomes very attractive as well, and there's opportunities to still lock in with fixed rate debt on deals. But I'm excited about placing some more of this institutional capital that I have relationships with into deals now too. So that's the other key difference. I think a lot of the institutions weren't quite set up for 2008 until a couple of years later. It really took 2 or 3 years for the bottom, but largely residential's done so well. We had a pretty much a bull run in the stock market for the last 15 years as well. There's just a lot of well-capitalized groups right now. Because that was the other thing, both real estate crashed and the stock market crashed in 2008. So
that's right.
That was a double whammy. Now, I mean, who knows? The stock market's close to all-time highs again. I'm not really a stock guy. I do play around with options trading, but that's a different episode. We've done a few episodes on options trading.
Yeah, no, I know what you mean. The stock market is moving along fine, and I like what you mentioned about seeing opportunities for assuming this kind of fixed rate debt that we're seeing. We've looked at a number of deals in the past few days even that are assuming 3 to 5 year loans at sub 5%. Some even sub 4.5%. Again, in different markets and different asset classes. And there are great opportunities out there. So, and it's good for us that we get to be we get to really pick and choose.
Yeah, I think the most important part to be a successful investor is to see deal flow, to understand the deal flow, and the only way to understand the deal flow is to see the deal flow, to be involved, to be in the market. Some of these larger placements we're doing is because we're invested. We have one deal we're in that is a bit challenged, but it puts us in the driver's seat to potentially broker. Well, I won't say broker because we're not licensed brokers, but facilitate and advise on a $70 million potential acquisition. The only reason we know about that is because we're involved and we're active participants in the deal, and deals come to us like that every day. This one we're already an investor in, but we have maybe 20 plus groups that we've vetted, worked closely with, that we've known for many years, and each of them finds a few deals a year. So we're getting probably 60 or more quality deals, and maybe we do 20 of them at most, just because of time and bandwidth. So just building that pipeline of opportunities, and diversified as well. It's not just multifamily. It's we're working on a marina RV park right now. We've done storage. We've done mobile homes. Personally, I've even invested in ATM machines and oil and gas. It really runs the gamut. I've done a few venture capital deals. I know you had some past experience in venture as well. It's not a big part of my portfolio, but I think it's important to do a little of everything and be some people say really focus on one thing, and there's certainly benefits for that. But I also think diversification and being somewhat of a generalist so that you can pivot when things. So I'm probably a contrarian in that. Maybe a dare I say, jack of all trades.
Would that make me a Zack of all trades?
I guess so. This is getting corny. We should. On that note, anything else to close with?
No, I mean, I think there are a lot of really good takeaways for our listeners here. We have, differences between 2008, differences between commercial versus residential. We've gone into what we're seeing with strong operators, what we're seeing with what the deal flow looks like now, how it's changed, and how, we're all fortunate to be in a position where maybe we don't have to overpay for deals the same way we did a few years ago. And, anyone with a long enough time horizon here should be able to capitalize on all the opportunities we see. So I think this has been great, Jack.
Yeah, very, very well said. So thank you for that. We're going to wrap this one up. If you're listening on YouTube, please like and subscribe. Leave us reviews on Spotify, iTunes, or your podcast platform of choice. And please connect with us on all social media, Facebook, Instagram. We do have a Facebook group for Alternative Investor Mastermind. There's some great chats happening in there. And we'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.